Good morning, ladies. Good morning, ladies and gentlemen. Welcome to this webinar, Thursday, 14th of March. Welcome to you all. We had 170 registered, so it's going to take a couple of minutes to everyone is coming from the meeting room into the webinar. So just a couple of soft introductions. The today's webinar is a particular focus on employee incentive schemes, and a vital consideration for any employer wishing to attract and retain the best talent, as well as maintain a loyal and committed workforce. The speakers today are going to canter you through why employee incentive schemes are, in our view, quite vital. The non-taxed and tax plans, the technical speakers will canter you through the taxed and non-tax plans, and there'll be a particular focus on employee ownership trusts. So there is a presentation in front of you, ladies and gentlemen, which will keep the speakers to time because we've only got an hour. The presentation will be sent to you separately by email, so you can use it as a reference document, but it will assist both the speakers and myself and the delegates to keep up to speed with what's going on in this webinar. Ladies and gentlemen, there is a link that we're going to send to you, which will be, I believe, in the chat box. That's top of your screen, the chat box. If many of you are familiar with Microsoft Teams. And that is a quick questionnaire, which, if you have the time, especially while I'm doing this introduction, and when you get the link, just click the appropriate box, submit, so that we can keep relevant focus on the delivery and future deliveries that we'll make in the course of time. It's your webinar, so there is a Q&A button. I've got it open at the moment, and invite anyone and everyone to submit questions so that I can raise questions, your questions, to the speakers and make it particularly pertinent and relevant to the audience raising questions, and our speakers will find time to do this as they canter through the presentation, and there's a Q&A session at the end. So don't forget the link, complete the link, and I invite you to do that when you have the time. My name's Simon Denton. I'm your chairman today, and my first job is to introduce the speakers. Speakers from the Sovereign Group and Alexander & Co, and our technical special guest speaker, John McCaffery, a tax partner and head of tax of Alexander & Co, joined 10 years ago in 2014. Previously worked with KPMG, PwC, Grant Thornton. He advises entrepreneurs, individuals, families, and businesses on tax issues and planning. My colleague Stuart Stobie is the co-presenter, co-speaker, and Stuart has worked in the trust and fiduciary tax planning industry for over 20 years, with careers in Hong Kong with Grant Thornton, even with Coutts Bank in Zurich, and many years spent with Sovereign in Hong Kong, our sister headquarters, Gibraltar, our headquarters, and he's the managing director of our Trustee and Corporate Services subsidiary in Chester. Again, I'm your chairman, Simon Denton, representing the Sovereign Group. A group, next slide, Sophie, please, or Stuart. A group that has been in existence for 37 years, independently owned, in-house owned, delivering private client services in the shape of trusts, even after the budget. Yes, very much trusts of all kinds, corporate services, often covering international tax, asset and wealth protection, corporate services, helping UK European companies to expand and undertake cross-border migration into Africa, the Middle East, Southeast Asia, and the EU. An element of retirement planning, that's international retirement planning, which tends to go hand in hand with persons leaving their home country, like the UK, perhaps pre-election, into different jurisdictions. But that's enough about sovereign. So again, Stuart, we can go to the next slide and again try to keep to this timetable we have to get a lot through in the hour. And we've got 170 registered, and there's still people coming in. So I'll dispense with my introduction. Invite John and Stuart to officially commence proceedings, and it's why consider employee incentive schemes. It's often a question we are frequently asked, and no doubt will be asked. Why should we consider employee incentive schemes, gentlemen?
Well, if I jump in first, John, if that's okay by you, just as we're trying to make this presentation as informal as possible. So there'll be some back and forth, and obviously there'll be Q&As for us to look at. So so hopefully it's a bit more informal and interesting. But basically, just to start the ball rolling. Excuse me. Why would you consider employee incentive schemes? I mean, on the screen you can see the various reasons and the rationale, but why you would consider these schemes. Basically, there's been all sorts of research done, which have shown that by having employees engaged through ownership or incentivized in certain forms, the company basically is more productive. There's greater revenue. You in these years of these times, of the need to retain staff and the cost of actually training new staff. Again, by utilizing the employee incentive schemes, you have there's an increase in retention. This is all, various studies have been undertaken. On that list also, and I say, what this cost me, yes, but as I say, it ultimately retaining staff, greater returns, increased profitability, and more effective business. It's been proved time and time again. The other thing which is actually missing off that list, and we will come to later on, is also in certain circumstances it offers current owners exit strategies from their businesses. Again, rather than relying on trade sales, you can actually look to the employees to acquire your company, and the government and there is a consultation paper out on this in regards to how things are current structures, but the government is encouraging this particular arrangement. But let's take a bit of a dive into the actual incentive scheme. So and I'm going to pass over to my esteemed colleague John McCaffery, who I will pronounce his name wrong, despite being told off for spelling it wrong earlier on today. Apologies, John. John and I have worked together for years, probably far too long for John. And John is a spouse expert on all things incentive schemes. So, John, obviously we've got a list up there right now in terms of the various non-tax advantages, and funny enough, we'll come on to a slide for the tax advantage ones in a minute. But do you want to just give the audience a sort of brief sort of summary on what those schemes are, and then we can look at the way they're structured and how they may apply to certain companies and certain employees in certain circumstances.
No problem at all. And good morning. Hope you're well.
Hi, John.
Yep. So as we've opened up, employee incentive schemes, all about staff retention and growing profits and that kind of thing. As Stuart alluded to, there are non-tax advantage schemes and there are tax advantage schemes. The tax advantage schemes are generally those that are approved by HMRC, and people often ask a question as to why HMRC might approve an incentive arrangement. It's not a benevolent reason in any way, shape or form. 70% of the tax take in the UK comes from PAYE and national insurance. So they very much like having people employed and engaged in businesses. And if those people are employed and engaged in businesses and are striving towards profitability, then they get more tax. And as a result, we have these arrangements in place that allow the revenue ultimately to give a little here so they can take a bit more later on. But it does work for the individuals in certain circumstances. The key to an incentive arrangement, if you are a business owner, is making sure that you get it right for your business and your structure. Yep. A bad incentive scheme can completely undermine your business, not deliver the results you want. So in what we're going through today is we're going to be looking at the various schemes that are available. I'm going to give a little bit of an overview of typical areas why they might be used. One might be used over another. Okay.
John, just jumping in, are you suggesting therefore that some of these schemes, there may be some, let's say, fashion trends or fads around certain schemes?
So for example, there's let's say that the main tax advantaged incentive scheme we come across is the enterprise management incentive, right? And I have to say, in terms of that, there is an idea amongst certain tech companies, biotech companies, that kind of thing, that will do a company-wide EMI arrangement, and then more people come in, they get more of an EMI arrangement, and then they find themselves in this great big difficult position whereby they've got hundreds of staff with tiny EMI options set at different prices, not incentivized in the slightest. Yeah. But they've been told that they need to do an EMI because that's what the trend is. Yeah. An EMI is a great tax advantage scheme, but should really only be given to key individuals who are going to drive wealth into the business. Other individual, I mean, we're talking junior member staff, would genuinely much rather have a bonus because they understand it, cash in the back pocket. So
I think the emphasis here for the audience, people listening is that, you know, we hear about certain, like as John says, certain EMI schemes will come on to employee ownership trusts, which are again in the press a lot and talked about a lot. I think just make sure that, again, you walk in and talk to people like before, you know, again, you're down the golf club and somebody says this works for us. Well, it might work for you. But will it work for me? And again, this is the emphasis on taking advice before leaping, and then things. Because not only is there making sure it's right for you, your company, and your employees, there's also things like tax and compliance issues to consider as well. Which is why we're touching on the unapproved schemes first. To make sure that you're aware of the difference between the two. Sorry, John, I just
no, absolutely, Stuart. It's a very key point. And to be honest, there may be, as I say, a place for a non-tax advantage scheme over an advantage scheme because it suits the commercial requirements better. Well, you're dead right. There is compliance with all of these. So what it means by non-tax advantage scheme is that, one, it's generally not approved by the revenue. Two, it's not always the case that they're not tax efficient, but they are generally less tax efficient than the tax advantage scheme. Just having, say, a quick trot through what we've got on the slide in front of us there. An LTIP, long-term incentive plan, is actually just a broad title for a long-term incentive scheme, right? And actually it can cover, it's sort of an unapproved option type arrangement in most cases, but not always. What an option is a legal right to acquire shares at a particular price in a company. Now, if it's unapproved, you might acquire the right, say, £1 today, but if in 5 years' time, when you exercise your option, the shares are worth, say, £10, you will pay income tax on the value of the difference between the pound you pay and the £10. So you're paying income tax on the £9. Generally, you're paying it in through PAYE. Often this is done by large companies because it's pretty easy to do and can be company wide. And often they are set up so that actually what happens is that these are put in place quite regularly by listed companies. Because basically then they can take the shares, they sell some on the market, they cover your tax charges, and you get cash. To all intents and purposes, it's a bonus through a share arrangement.
John, would the LTIP be relevant to key members of staff or any staff?
An LTIP in terms can be either key members of staff or any staff. There is often in some organisations or larger organisations a requirement to bring the entire staff body along. Sure. And so long as people communicate it in the correct way, Stuart, it can be effective. If you can say, this company's on a growth path, we are looking to increase the value of this company, you join us for that, and ultimately we'll pay out by you sharing in the growth of the value through a share arrangement. Benefits to them are that they are relatively straightforward to administer, and don't require all sorts of like the rules that the more tax advantage schemes.
All right, and you may enter that once you've had perhaps past probation and all done a years of service, and you're committed to stay in the company. For
all sorts of terms on these things, and I think I think the point being here is that it covers a number of eventualities, but basically at the end of the day, it is an incentive scheme to which they're without the tax breaks.
Indeed.
I think, and you could probably apply the next do the growth hurdles, structures and things like that to the same sort of thing because it's a similar sort of incentive.
Yeah. And we may as well move on to that, Stuart. So a growth scheme actually can be quite tax advantageous. So there's a way of incentivizing people that if you've got key employees or directors in a company, or even more broadly than that, you could consider just giving them shares, right? Now, the problem with that is if you give them shares that have any value in them, they are immediately taxed on the value of those shares, right? Yeah. Depending on the type of company you are, if you are a privately owned company, then those are generally taxed through a person's tax return. But then that might require a person who's not done a tax return before to do a tax return. If it's a company under the control of another company, so sometimes you'll have a holding company and you want to incentivize key staff in various subsidiaries, but only in relation to that subsidiary. So if you just give them shares that way, then they get taxed on the value of that, but that might be through PAYE and national insurance, giving you a employer's cost. And anytime you get a listed entity or where there's a sale, anytime there's a market for the shares, that will be subject to PAYE. Right. Now, the idea behind a growth or a flowering share, from the tax advantage point of view, but also from the point of view of actually trying to drive growth into the business, is that if you are given a share and you know the current value of the company, and you set the point at which people can share in the value of the company sufficiently above the current value of the company, that share has a much lower value. It doesn't have any existing value. It's only got the future hope value. And the revenue accept that hope value is a relatively small amount, and therefore any tax charges on the issue of those shares are limited. Okay. So what it allows people to do is put these in place and say, right, it's particularly, it does work well with management teams. It's kind of like, okay, let's say a company's worth 5 million. We've got a target to get to 10. We will say you can share in value if we get above 6. And you can put it in stepped amounts. You can put it on whole amounts. You can cap that value. They are really, really flexible, but pretty tax efficient in terms of the fact that there's no upfront cost for the individual. And anything above the value of the growth is subject to capital gains tax on them, which is at lower rates than the income tax charges. Yeah. What you need to be particularly careful with is the legal requirements. So you want to make sure that if these people leave employment or go somewhere else, unless you say so, the shares disappear or come back from them.
I think on that particular point, John, that I mean, obviously this particular one is quite a straightforward, simple way of incentivizing key management to aid in the growth of the value of the company and participate in the growth of that growth of that value, and therefore people are all heading in the same direction, and and for all the reasons we gave earlier, they are then incentivized to work and to be loyal to the company, stay with the company, because obviously if they leave. The other thing I think, just which John has raised there, that point there, is in all of these plans you have to consider the staff exiting, what happens in the event that staff exit the company, and make sure that's covered off, because otherwise you could potentially, I know most companies are aware of this, but you could be in a world of paying by staff leaving and going, thank you very much indeed. Somebody forgot to put in a bit that you have to basically give your shares back. So just be aware of that particular issue. I think that's pretty. I don't know what your further thoughts on that, John, but it's you'd imagine it's an automatic thought process, right. But it's not always.
I think I just saw a question pop up
there.
There's
a question here, John. Can you legally cancel a growth share for a leaving staff member, or would you need to formally buy them? Good question, sir. That was Michael. Right. What's your answer to that, John?
So it depends on how you structure it to begin with. Yes, you can legally cancel it. It depends what value you cancel it. So from a tax point of view, by cancellation, what you're doing is a company buyback. So the company is acquiring its own shares and then cancelling them. It's not something you can just cancel. In those circumstances, if it's an agreed price of no value, because that's what's said in the articles or the shareholders agreement, generally fine. There's a little bit of complex tax risk around under a bit of legislation called employment related securities, which is a whole 4 or 5 separate webinars. But if they are getting some value for it and they've held those shares for less than 5 years, they would be taxed as though they've received a dividend. So you need to be a little cautious about something like that. Or you can set up an arrangement whereby, I know, using a trust, for example, and you need to be a little careful with trust. You use a trust structure to acquire those shares and take them away from the individual.
Thank you, John. Also, if you want to raise any more questions, ladies and gentlemen, hang on, Stuart, please use the Q&A device. And I've just been reminded there was a questionnaire sent to you all in chat, and thank you for completing it. But if others can complete it, it's relevant to your webinar this morning. Thank you.
Yeah, just on trust, I think obviously we will come on to the use of trusts to hold shares in companies and how that can create internal markets and also enable and protect employees, but also in terms of exiting employees as well, how they can be managed more easily through those structures. But we will touch on that further. But again, there are sometimes considering trusts in certain varieties to hold shares is worthy of consideration.
Joint share options
nicely plan. To the joint share ownership plan, which has to use a trust.
Yes.
Yes.
look how that fitted.
Indeed, an amazing segue. Beautiful. Joint share ownership plan. So a joint share ownership plan is quite a complicated arrangement, actually, and they're not used very frequently anymore. It's probably because there are simpler arrangements in place, such as the growth flowering hurdle shares. A joint share ownership plan splits the legal title and the beneficial title of a shares in a company for the benefit of employees. And the only way really to split legal and beneficial title is to have the certain shares held in trust for the benefit of the employees. And what it allows is basically for, again, the hurdle growth is set on those shares. If it is achieved, employees benefit from the shares held in trust when the company exits. Again, okay, John, it's a lot more complicated. Sorry, Simon. Yes.
John, there's a quick question here which may be rated from Cada. Thank you. Can we just use a general why is a trust is mandatory while the listing company wishes to execute an ESOP? Maybe we're coming on to that a little later, but and answer it later if you wish. I've been told by a person that they cannot access Q&A, but they may be able to raise the questions in chat. So just do whatever's easier. And can we just use a general CADA again? Can we just use a general platform rather than an ESOP platform?
I'm not sure about platforms. The joint share ownership plan, it's because it's a specific arrangement. A joint share ownership plan does use a trust. An ESOP is an employee share ownership plan, which is kind of just a form of long-term incentive plan. And
That's
actually, they are more flexible.
Okay, thank you. And thank you for your questions as well. Excellent. I think we're on to nil paid shares now.
Nil paid, partly paid shares. That is quite simply a gift of shares to the individual, but instead of them getting a tax charge, so as I was saying before, we've put hurdles in place so we've got low value. But if you do wish instead to actually give individuals some value in the current value of the company, and they don't have the funds available, you can issue them shares, but with an IOU from them. So they are in fact paying for them, right?
Sure.
Now, what's probably of interest here is when you're doing this, it's generally you're giving smaller minority holdings in companies. And the individual is taxed on the market value, but the market value can be discounted quite substantially from a tax point of view based on the level of influence and the size of shareholding. So say an individual with a 5% or less shareholding, the 5% may carry votes and it may have some dividend rights, but those 5% votes are pretty irrelevant if somebody else has 95% of the votes and controls the company. Yeah. So a 5% shareholding or less can attract up to an 80-90% discount against open market value, and therefore you would only be taxed on the discounted value, right? Little bit of an issue with nil paid and partly paid shares in that you've got employees and directors who would owe the company money. If that loan is greater than £10,000, say, there is an annual benefit in kind if you're not paying at least 2% interest on that loan.
Wow.
Yeah, which again just re-emphasizes to anybody listening in is that you can put these. You think, okay, I don't want to go for the very complex and the schemes which we're going to come on to now, not complex as such, but where they need HMRC clearance in a lot of cases. And you think I'll go for a cheap and cheerful option, potentially cheap and cheerful option. But there again, as John has emphasised in the nil paid and partly paid shares, there's potential tax consequences, negative tax consequences, and therefore people need to be aware of that. So again, I will continue to state this. I know we're in professional services, but we will we have emphasised the need to take advice, because otherwise you could end up in a world of pain and disincentivizing your staff members as a consequence, because with benefit in kind taxation.
Exactly that. Exactly. The other thing, Stuart, is it's not necessarily just kind of like, it's a simplicity. It's sometimes the tax advantage scheme may not be available to your structure on what you want to achieve.
Yeah, exactly, due to size staff and turnover, etc. So come on back. I left in a point in terms of occupation and saving schemes. Obviously, we're primarily focusing on shares. Obviously, I thought it worthwhile leaving it in. Just to say, look, obviously, in terms of another incentives, that there can be occupational savings schemes in there, but we're focusing on more the sort of utilisation of shares as an incentive to retain staff and increase revenue. So I will go on to the next slide.
Just a quick one, Stuart. There's a gentleman, Billy. If we apply 80% minority discount when the options or shares are created, will HMRC not challenge the eventual share value, and that the minority discount should be applied again?
That really depends on the type of arrangement you are using, right? So places you can't apply a minority discount is if there is a open and full value market for the shares. So if you're a listed entity, you're always going to be able to sell your shares at full price. If you have a sale of the business coming up and recently get issued your options, you're going to achieve more or less full value, right?
Yeah.
If you have an unapproved option scheme, let's say, so that was like the bonus arrangement, and you exercise your option to acquire your shares. Now, as I said at the outset, you would pay tax based on the market value at that date. If you're a private company and there is no sale in the offing, you can absolutely apply a minority discount because the revenue allows it. If you exercise just before a sale, there's going to be no minority discount because you're about to achieve full value.
Yeah.
Yep.
Okay. Thank you for that. I'm glad you answered that one, not us.
That's why he's here.
Thank you again, ladies and gentlemen, for completing that form. It's in the chat room, and if those that cannot get the Q&A button, just carry on in chat. Looking forward to your continued questions. But we've got statutory tax advantage employee share plans now, and taking enterprise and management incentive EMI plans, which some of you may have heard of before.
Yeah, EMI plans is like the gold standard of
Yes.
tax advantage schemes. They are, if you can do an EMI, you do an EMI because the benefits are generally outrageously good. Right.
Very good.
But as a result, there's a bunch of conditions attached to them. So, and this is why sometimes it doesn't work. An EMI has to be in the top company in a group. It cannot be in a company that is under the control of another company.
Okay.
The gross assets of that company can't be more than 29 million, excluding intercompany balances. Yeah. And what it allows you to do is you can issue shares. As I say, I often use them for key individuals. So these are generally key people to your team who are invested in the growth of the business and going to be with you for the long term. Yep. They can be used on a company-wide basis, and some people do use them. You get to a little more complexity when you do that, and you've got to make sure it's right for you. But basically, you can. So what you do is you have your company, and let's say your company's worth 5 million now, right? And the company decides that it's going to issue, say, a 5% EMI option to a key individual. Right. So what you do under the EMI is you go to the revenue and you agree the value on that 5%. Right. And discounts do apply, subject to exit coming up. But basically what you're doing with an EMI is like, right, I'm looking for growth and I am going to incentivize this key individual because I believe they are key to the growth of my business. So we've got it worth 5 million. 5% would be worth 250,000 on a straight line, but we can apply up to an 80% discount. So we've got an option worth £50,000, let's say. Okay. You enter into the option arrangement with the individual. The individual can only exercise that option. You can put these whatever conditions you like in, but usually it's only in the event of an exit or a sale of the business. Okay. Now, if it sells a year later and there's no growth in value, that individual may well get £250,000, and they already quids in because they are 80% up in value. If we're looking 7, 8, 9 years later, and the growth of the company has gone to 20 million, right? They are getting up to £1 million in value. Yeah. All that value is taxed to capital gains rates. There's no income tax charges. Up to £1 million of that is taxed currently at a 10% rate of tax, and anything above that is taxed at a 20% rate of tax. Correct. The benefit to the company is the difference between the value when the option is exercised, sort of on the date of sale, the £1 million, and the amount paid by the individual, £50,000, is corporation tax deductible. So they can get an increase in their own value by decreasing their tax charge and making themselves more attractive to a seller. Yeah.
Yeah. Very good.
All round. Now, the key to an EMI is that the benefits only last for a period of 10 years. So you're looking for a situation whereby you're looking for an exit in a 10-year period. Otherwise, all of the key tax benefits are lost. The other thing with an EMI is it's definitely for key employees. So that individual has to work for the business. Generally, it has to be a trading business, can't be an investment. Certain out there trades like financial services are usually excluded from these kind of arrangements. But the employee needs to work either a minimum of 25 hours for the week, or if they're a part-time employee, at least 75% of their working time for the company. And if the individual leaves employment, the option lapses. Yeah. So it's very much about tying people to the business.
Okay. And a related question, John. Yes. Maybe it's to do with the next item. Does the employee need to find the £50,000 to pay for the options? So that's from Michael.
Let's say it's on a sale, right?
Yeah.
What happens is technically yes, but you've got a bit of a money go round. So you get your money from the sale of your shares, and 50 grand of that is kept. Yeah, that's why it's usually exit only. Now, if it was another situation whereby it was not on a sale, then yes, the individual would need to find the funds to pay for the shares.
Yeah. And he's a little snippet from the same. Michael, are IFA firms excluded? That depends how they're structured.
That's a bit of a question, really. That is right. So, financial services are excluded, but industries that support in an administrative function in some way, shape, or form, so aren't actually undertaking financial services themselves, aren't.
Righto.
Right. So if the financial services firm is making the investments, then probably excluded. If the financial services firm is an advisory firm, then no, they may not be excluded from EMI. You can go for advanced clearance with the revenue. So you can apply to them and see if you're a qualifying entity for EMI purposes.
Good. Okay, let's move on.
Okay, so company share ownership plan, option plan, sorry, is EMI light. Now, the thing about EMI is it gets you can issue up to £250,000 worth of value per individual, but to a maximum value of 3 million. Company share ownership plans are similar to EMI, but you can only issue up to £30,000 worth of value to the individual. These are often used in much bigger organisations. Yeah. Similar conditions, except for the fact that on disposal, you don't get the 10% rate of tax. You are at standard capital gains tax rates, which are currently flying at around 20% if you're a higher rate taxpayer.
Yeah, thank you.
Okay.
Yes.
A lot of listed entities use company share ownership plans. Save as you earn. Save as you earn again, and this is the next three are actually company wide. The bottom one's a bit more interesting. We'll come on to that quite rapidly, actually, because that's where we wanted to focus a little bit today. Save as you earn is basically a company-wide scheme whereby you can offer, and it has to be made an offer to all employees, to do a sort of salary sacrifice arrangement to buy shares in the company. It lasts 3, 5, or 7 years. You can get a bit of a bonus on those shares, and you can offer up to a 20% discount on the market value. Again, it's if you want to bring a lot of people along with you. It's tax advantaged, but not particularly brilliantly tax advantaged. Yep. You can at the end choose to take the shares or actually take the cash saving as a bonus with the 20% up, and that bonus is tax free. Share incentive plan, despite sounding like it could belong to anything, is actually a specific scheme, and what that allows you to do is, again, very broad. It must be available to all employees who've been with the business a certain amount of time. You can discriminate on the grounds of when you're issuing the share award. You can on contribution to the business, remuneration, that kind of thing, length of service. It allows you to give up to 3. So this again must be held in a trust. It's up to must be held in a trust for up to 5 years to get all the tax benefits of it. You can, per employee, they can have up to £3,600 worth of free shares in the trust. They can purchase out of gross income up to another £1,800 worth of shares into the trust. The company can match 2 shares for every 1 share purchased in the trust. And as a result, you can get up to about 9 grand of benefit in the trust. Now, if the shares stay in the trust for 5 years, when they receive the shares, they receive them free of tax. And if they sell them straight away, they don't pay. They don't pay capital gains tax. If they keep hold of them and there's a growth in value, they will pay capital gains tax from that point forward. But a share incentive plan is very much a larger company, share wide, bringing everybody along. In those circumstances, actually, I mean, it's quite tricky to administer that one, and bonuses might work a little better. Yeah,
absolutely.
I think the and then the last one on the list. These are the easiest set of slides to prepare of all time. Basically, John just wanted to say 2 slides, and that'll do us, which I'm happy with. But we employee ownership trust, and obviously from us as trustees have come across our radar screen for a period of time now, and obviously, we not only here in the UK but elsewhere where we have offices, and obviously with the that there has been a certain quite a substantial increase in the utilisation of these. So my question to John would be, why suddenly has there been this sort of major explosion in interests of employee ownership trusts or EOTs? And considering, because if you read the let's say the PR on them, is that basically you'll hear this all the time, is like democratization of the workplace, and try not to be too cynical over that, and also the John Lewis model, which is known for it to be owned by employees, though obviously there's been a fair amount about that in the press recently as well. But anyway, John, in terms of the sort of genesis of the use of EOTs and the growing popularity of this, we give some insight into why you think this, but also obviously an overview on how they actually work.
Yeah. Right. So EOTs are most definitely the flavour of the month, and the simple reason for that, Stuart, is business owners who transfer their shares, and it has to be a controlling interest of the company, that disposal is tax-free, right? So there are business owners out there who are looking at EOTs in order to obtain a tax-free exit on the disposal of their business.
Yeah.
And it works well in the right circumstances, and it works very badly in the wrong circumstances. Okay, so the way it works is basically you have a couple of business owners, right? They have 100% of the business, and they decide they would like to exit that business, and let's say it's worth 10 million quid, right? Now, your key is that you have to get a valuation on the business, because of the obvious tax advantage there, the revenue are not going to allow you to have vast amounts of funds taken out of this business in a tax-free manner if that business is not worth that amount. So you have to set your value, right? Now, essentially, you set up a trust with a certain company structure and nominee arrangement and that kind of thing. and the individuals sell their shares to the trust. Okay. The question then is, where does the cash come from?
Yeah.
Yeah. Right. And there are a couple of ways. One, the trust can borrow, but then the trust has got to be able to fund the repayments.
Yeah.
So the second, or the most usual place it comes from, is actually the company that is being purchased.
Yeah.
Yep. And how that works is that the company effectively makes contributions to the trust. Now, the company can either use its own cash reserves, or again, the company can borrow. Yeah. And make contributions to the trust. Those contributions are not tax deductible in the company. Yeah.
Yep.
And also, they are deemed to be a dividend. So you actually need to make sure, so this is for company law purposes, not tax purposes. You need to make sure that there is sufficient reserves in the company to be able to make those contributions.
Yeah.
Otherwise, it
John,
all falls horribly.
what is the Michael? Thank you, Michael, for the couple of questions. Given that this arrangement is relatively new and obviously not to be confused with an employee benefit trust,
Yes.
which kind of companies currently, or in the last year or so, are the ones taking this up? I would say private companies, and companies
private.
looking to exit. But please answer Michael's question.
No worries. It's private companies with individuals looking for an exit.
Yeah.
Okay. Any particular nature of company?
No, I mean, I can't remember the employee ownership associations took out a stat. I think there's been a couple of hundred last year, but they were right across every single sector. Yeah, so I think as in terms of, you look at it on employee ownership trust on paper for an owner looking to exit with, and also wanting to leave a legacy, in terms of wants to maintain his legacy, what he's done with that company, because he's got, and therefore incentivize his staff to remain and keep their jobs and run the company, rather than a third party, say a private equity company coming in and buying it, or a third party trade coming in and buying the company. It looks very good on paper. And obviously, as John has explained, the 100% tax, 100% capital gains.
Any tax, capital gains tax free. Yep.
Yeah, relief is an amazing incentive for obviously anybody in their right mind looking to sell the company goes, hang on a minute, that's an excellent exit. As John has also pointed out, there is some complexities around how finance that particular that arrangement, whether you're reliant on capital distributions in form of dividends from the company up into the trust. Because there'll be the trust then to pay the owner off under deferment arrangement, and of course that deferment arrangement has to be considered, and what happens if those something happens with the company on which you're relying on the cash to pay off that deferment arrangement, and what are the terms. So again, that's an issue. Obviously, in terms of looking for third-party financing, does a trust really want to be entering into a debt arrangement with a third-party financier, when again it's reliant on capital coming up, distributions coming up from the company, or as John has pointed out, the company itself borrows that money, and then, but again, there is all sorts of issues in terms of that's basically deemed as a dividend, and therefore it's got to be taken from surplus cash. So there's quite a lot of complexities there as well to consider in terms of how that is structured. So on just quickly, when we're comparing, also when we were looking at the share incentive plan versus the employee ownership trust, in terms of the participation by employees, in terms of the EOTs, does it have to be all employees have to be able to participate?
Yes, they do. But again, there's a little bit of a get out at the beginning, depending on length of service. But yes, it has to be, all employees need to participate. It needs to be on relatively similar terms, but there can be a level of discrimination, again, based on contribution to the business, length of service, and the remuneration they receive. Which kind of brings you to the nub of the issue, Stuart. It works brilliantly in the right circumstances, But actually, what you've also got is a circumstance whereby, as an owner of the business who may have driven the business, you are then handing control over because you've sold a controlling interest in the business.
Yeah.
The way the shares are held by a trust, and it's critical that actually you get the correct trustees in, because it's made partly up of employees, but you're no longer running that business. Yeah.
Okay.
And as you've rightly said, all employees have got to share. So you've not got any key individuals who are sufficiently incentivized to drive the business for their own personal gain. Now, what a lot of people are looking at doing at the moment, and you can do this, is they are coupling an EOT with a less than 5% EMI.
Okay.
Right? For those key individuals, so they can continue to drive the growth. Now, I've seen it work brilliantly. I've seen it work terribly. Because whilst people are attracted to the tax-free exit, if they can't control, there's nobody driving, right? And they're looking to arrange the cash, they haven't got the cash out yet, and the business might collapse. So you've had a tax-free exit, but you've not actually had any value from your business. So you really, really do need to consider whether it worked commercially for you. And you definitely need to put in the correct corporate governance to make sure it does work for you going forward.
Yeah, I think coming from this, and I don't think anybody listening will be surprised to hear me or Simon say this as people who work for a professional trustee company, is that the concerns that we see, obviously as professional trustees on acting on various forms of trustees here in the UK and across the globe, is where we see with employee ownership trusts, where we see employees appointed the board of trustees. Also, the other concern is, and I'll come on to this what's happening there, is where the original shareholder who sold his shares is also on the board of trustees and actually may be controlling the majority of the board of trustees, and therefore effectively has not relinquished control of the company, and therefore isn't at a conflict of interest, which again, as a trustee, you have got to avoid. And there's various other issues like that, and to address that issue in terms of the seller, the original owner of the company selling and then sitting on the board of trustees. There was a consultation paper which was circulated last year by the government. I think it closed the back end of last year. We were promised some sort of policy by, I think, April the 6th. They have only got a couple of weeks to complete that. I think their attention might be somewhere else. So let's not say it. But basically, there is an issue, and it has been noted by the government and their expressed concern that previous owners are sitting on the board of trustees and therefore not really relinquishing control, but getting all the tax benefits already. So that there is that concern there. Also, there is also in that paper, they're looking for clarification around the funding of the EOT by distribution of capital to make sure it's all tax free, because obviously there's issues to consider there. But basically, our concern, my concern as trustee, is that we always acting as having an independent trustee, such as, to be blunt, ourselves and our direct competitors sitting on that board, being the trustee, what we know what we're doing in terms of making sure that the liabilities of the duties of the trustees, which are fairly huge and extensive, and as a personal individual trustee, you will be personally liable for any breaches of that duty. Now, you might think and also you've got to remember this, if you are an employee or even the previous owner, and you're now sitting on the board of trustees and something goes wrong, that you are answerable to the beneficiaries. The beneficiaries are actually your colleagues, the people you work with. That could be rather, the office around the water cooler could be a little bit interesting if something's gone a bit wrong with the management of that particular asset, those assets in the trust, which those are the shares trust in which you as employees are the beneficiaries. So again, I know that there's been, if you look at the Employee Ownership Association and other, there's been a lot of pushing of these things, of EOTs. As a professional trustee, a company which provides professional trustees and special trustees, and over 9 licenses around the world, are always concerned. We've always been concerned whether it's been a simple, family trust where member of family or friend of family becomes trustee, and we go, hang on, there's a massive conflict because somebody can get in their ear. Similarly, where you have previous owners and employees sitting on the board, that could create conflict, and also the fact that you're responsible for basically, a certain amount of an asset, effectively a certain amount of wealth, which should be contributed to employees, which are also your colleagues. And do you actually know what you're doing as trustee? Do you know what your liabilities and responsibilities? So I think from our side, and again, I appreciate the fact that you can quite easily see our bias here, but there is a real strong argument for considering professional trustees, because I think we've seen it in the past, and we'll see it again, where trustees do end up in court on a regular basis for not fulfilling their fiduciary duties. Now, if you're not even sure what your fiduciary duties are, and I have sat in meetings where I've heard employees who sit on the board of trustees not knowing even what the basic corporate documentation should look like, or that the fact they haven't seen the trust deed and read it and understand their duties, things will end up in court. And again, which is why we strongly argue to look at professional trustees. And again,
on that, Stuart, and as there's we're closing in on time. Do you want to move forward on your slides, because you actually mentioned this, don't you? There's a references.
No, we've pretty much covered that.
Okay.
That's it. So we were going to buzz through those anyway. So basically, John, unless you've got anything to add in terms of mine.
No, I couldn't agree more, Stuart. As I say, I think there is a massive temptation in terms of the tax advantage that sits with these things, but the potential for it to go horribly wrong in the wrong circumstances is large. And actually, people who are not used to, and I know we're talking about trustees, is the structure right? Have you sold it right? Have you got the key people in place? And are you running that trust properly is critical to the success of an employee ownership trust.
Totally.
On that basis, John, and just to people, there's more or less the same sort of number in the room that arrived. So thank you for staying on, ladies and gentlemen. Thank you for your questions. Goes about saying that everything that we've cantered you through this morning, the presentation will be sent to you. The recording, as I mentioned, is available for those that want to keep it on reference. We've got a couple of minutes anyway before those that want to stay in for a couple of minutes ask any questions. But what everything which we've shown, everything which we've run you through, the highlights in the presentation is what Alexander & Co. and Sovereign do every day. Nothing's outsourced. Alexander & Co. are a specialist in this field, clearly an expert. You can't blame John for reading from a script, especially the questions coming in and the questions that we've had previous to this meeting. Sovereign deals with the practicality, the commerciality, delivering the professional trustees both in the UK and overseas. I will take a couple of questions, although thank you for everybody for saying thanks and excellent presentation, and there was no coaching on that part. So thank you for your kind comments. Any other questions? I'll type away. Don't forget, you've got Stuart Stobie, Managing Director of Sovereign Corporate and Trustee Services in Chester. I assist with the supporting of that development as well. And I'm MD from London. John, Alexander and Co. In the northwest. There is any other questions? It's easy to find our details.
And just from my side, I'd like to thank John McCaffery.
Yes, absolutely.
Sits pub. I'm never going to live this down. For
you're
all
not.
his no, for all his impact. As you can see, John, say there were no notes there. I know for a fact I've sat in a number of meetings with John and quizzed John myself on the things. He has an excellent grasp of this information. So on all things employee incentive schemes, as well as beyond that in terms of tax. So I would strongly recommend John as somebody to contact if you have any queries on this matter. We will be sharing the presentation. We will be sharing contact details for John and his team. But I think it's now. Have we got any further questions?
No, we've just got a contact number, which John's contact number. You've got our contact details, which will be on the presentation when we send it to you. Or you can do UK corporate@sovereigngroup.com. But again, contact Stuart, John, myself for anything that you specifically need. We've got recordings, presentations. Thank you for your undivided attention. Still quite a lot of you in the room. But again, from the three of us, thank you. I think that's the close. We've not had any other questions. And thank you for your time today and speakers.
Thank you.
Thank
you for the opportunity, guys.
Listening. Right.
Take care. Bye-bye.
Bye-bye now.